Right, Seb, I make that just after 11.
Me too.
Sounds fantastic. Good. Should we kick off?
Yeah, let's do it.
Brilliant. Well, as always, thank you very much, everyone who's decided to join us today for our second webinar. It does feel only a few weeks ago that we were speaking about the Venture Fund, but obviously tax year end fast approaching. It's probably a good idea to continue the refresher and also supply any good news we can with regards to what I think is probably one of the most exciting VCTs out there at the moment. So today we're joined by Seb. I'll let Seb obviously do the introduction for himself. But while we're talking, we'll just put the important information slide up so you can all have a chance to read it.
Yeah, so hi guys, I'm Seb. I'm one of the investment directors at Triple Point. I, along with two of my colleagues, set up the VCT, and we're in charge of making all the investments, the venture capital investments out of the venture share class that we're here to talk to you about today. I've been at Triple Point since 2017 and have also experienced as a founder, as a lawyer previously, and now obviously as all of these years now being a VC and being in charge of this fund, and I'm really excited to talk to you about the opportunity.
Fantastic. I will not have such an illustrious introduction such as that. My name's Billy Round. I work in the sales team, but I look after a lot of key account head office relationships and compliance departments, which is just a fancy way of saying do a lot of presentations up and down the country. But today I think I will be the interviewer and you can be the interviewee, Seb. So we'll get going.
Yeah, sure. That sounds great.
Big numbers and a strong story from Triple Point, I suppose, for those that haven't used us before or maybe haven't sort of seen our significant growth, especially over the last 2 years of COVID. Do you want to pick any numbers out here that really stand out for you?
Yeah, no, I will. In fact, there's a few numbers that aren't on there that I think worth picking out as well. So Triple Point's been around since 2004. We actually started with VCTs. We're now a much larger outfit. We now have around 3 billion. It says 2.7 there. We're actually around 3 billion, which is just, it shows you how quickly we're growing. When we first had the webinar in October, we were at just under 2.5. We're now at 3. And this VCT offer, VCTs obviously being the core of what we do, is actually our 23rd offer. And what we'll show you and talk to you about today is really how this offer and the strategy of the funds about raising the right amount of money to deploy into high quality early stage companies. Overall, though, Triple Point's money comes from broadly 3 sources: retail, institutional, and sort of public government money, across 5 strategies. One is obviously venture capital that we're here to talk to you about today. The others are digital infrastructure, energy infrastructure, social housing, and then our estate planning and TP income service on our debt offering. And of course, Billy and his team can talk to you about that if you'd like. But yeah, venture capital is the bread and butter of what we're here, what we do. It's VCTs have been at the core of our business since 2004, and yeah, really excited to launch and close this 23rd offer.
Fantastic. And I don't know, obviously we all talk about things slightly differently, the way we proposition Triple Point, and the people, purpose, profit mantra for me, I think, is a really unique thing to talk about in the world of financial services. The way Triple Point does what it does and the areas investments it's involved in, they all have a really strong story behind why we do them. So that being said, let's look at some of those strong numbers and those strong stories. And it's all off the back of the fact that, there is a huge marketplace for VCT. I'm going to do very little of the talking today, but the reason we're here is to focus on the fact that the VCT marketplace is an ever-growing marketplace. I saw some literature earlier on this month that, this is on track for another record year within VCT. I think from the start of the tax year, April 6th, there's been about 580 to 600 million raised to the end of January. And you're at a perfect storm of ever-changing legislation within the world of financial services. Obviously, we had the change to pensions with pension freedoms. We had the changes to dividend taxation, the buy-to-let mortgage changes, pension allowance, lifetime allowance, contributions. People, I think, now have got to look further afield than just purely the vanilla financial planning products that are out there and have been the more well-established things such as pensions and ISAs. And we're starting to see VCTs and EISs form part of a wider, more holistic investment strategy for clients. And rightly so, because they really do offer a significant opportunity for someone's risk-adjusted return. I think that's why the venture VCT that we're here to talk about today really does stand well in the marketplace. Now, we always talk about the overview. I like to cherry pick a couple of these. Seb, to put you on spotlight, what are your sort of key things that you think really set the VCT apart from the wider marketplace at the moment?
Yeah, I mean, so the venture share class, won't dwell on financial performance today. We'll talk about that a little bit later, although it's been really, really positive. But I think the diversification our portfolio offers, the VCT's been around since its first offer was in 2018. This current iteration of the venture share class, it's a younger VCT, but we're already at 30 companies. There are other businesses that have been around for VCTs that have been around for 10, 15, 20 years, and they have 40, 50, 60, 70 companies. And so that diversification that we're going to continue to pursue is a real differentiator. And in fact, it's likely to be over 40 in the very near future, that although we're at 30 now. And we've also have a really young portfolio, sort of over 50% of the companies in the portfolio were invested in less than 12 months ago, which has allowed us an ability to really set the portfolio up for the post-COVID world. We'll talk about that a little bit more, but I think that's a real differentiator, which on this slide, it's at the bottom center, the early stage investment, what we really mean by that, and how we are genuinely early stage compared to other VCTs, a great complement to them. I think would be the big thing that I would highlight here, Billy.
Yeah, it's something that we talk about, I think, with a lot of our products, is that we're not necessarily here to say us over someone else, but why we work so well compared to the wider marketplace, which is a really strong message. And we talked about that people, purpose, profit bit at the start. I think, that we always like to put numbers that matter, it says there. I think the top line pretty much speaks for itself, with the dividend, the NAV, the total number of companies you've talked about, the sectors, which I know we'll drill into in a lot more detail, because again, there's some opportunities, some real interesting sectors that we've got exposure to. But I think the bottom line really sort of puts a bit more meaning behind what we're doing. And again, is there anything you want to sort of pick out on there?
I would probably touch on the 70% gain point. I mean, that's reflective of the stage that we invest. So we are focused on early stage, and by early stage we mean typically businesses that have less than £1 million of annualized revenues at the point we invest, and typically a lot less than that. And so with that comes some risk, and we mitigate that risk through our strategy, which we'll talk about, and obviously diversification is part of that. But the benefit is that we see uplifts that are third party priced reasonably soon after our investment, indicative of the fact that these businesses are growing fast, and therefore later stage funding partners find them attractive, and we benefit as a VCT from that. And I think that's a real distinctive element of what we do, and why you said, Billy, correctly, like, it's a complement to the other VCTs who are slightly later. We offer clients an exposure at an earlier stage, but trying to mitigate some of the risk that exists there.
And not to steal any future conversation on other slides, but I think it's quite good validation from some of our investments, that the fact that we've had other VCTs join us later on down the line. So again, the investment mantra rings true.
Yeah, no, exactly. Some of the biggest VCT names in the market that you'll all be familiar with are co-investors with us. They're friends on a personal level with me. Like, that's the way the market works. And indeed, they typically come in slightly later than us. Sometimes same time, mostly slightly later than us into deals. Yeah.
Fantastic. And again, I said the top line speaks for itself. I'm just going to labour on 2 points. Obviously, with the VCT, dividends are quite important for individuals. It's one of the reasons why they look to invest in them. Obviously, we've paid dividends to date, but I think that the fact that we were also pushing that NAV growth, this isn't just one or the other. This is looking for the best of both worlds: regular dividend income, but also providing proper venture return on this investment going forward. And again, to highlight just some of the things that we're looking at, again, you've mentioned the early stage investing, and on the very start, and that diversifier differentiator part. The thing I always like to talk about is the B2B over B2C focus that obviously this VCT has compared to the wider marketplace. Again, are we wanting to expand on that now? Is that something we'll talk about later on? Why the B2B focus?
Yeah. So historically, when we were thinking hard about how we structured the VCT and what its strategy was going to be when we began, one thing that was very heavy in our minds was the fact that B2B technology, regardless of economic circumstances, has always historically performed well, and indeed better than consumer businesses. It's fundamentally resilient to cycles. For example, when there's a down cycle, B2B is slower to discard, and also discard software, for example. And it also has latent demand. It wants to grow. Businesses inherently optimistic, whereas consumers are always cautious, actually, by default. And that therefore translates through right from the beginning to exit, that there are considerably more exits of B2B businesses than B2C businesses. We release a report called Exits in the UK with Bohurst. If anybody would like that report, Billy, then please ask Billy and the sales team, and they can follow up with it. But in that report, it showed that there are broadly year on year always around 2 times more B2B exits than B2C company exits. Why is that important? Well, exits obviously lead to cash returns, which leads to cash distribution, but also to NAV increase. And so by focusing on B2B, we're able to maximize the potential for exit and therefore performance in the portfolio. So that's always been something that we've really focused on, and B2B tech is our bread and butter. That is what we do. We don't really touch consumer businesses in this portfolio. And the portfolio itself, I'd highlight on the other point, because we've talked about differentiation in early stage investing to some extent. But the portfolio has been built post-COVID. As I said, over 50% has been invested in since March 2020. It's now actually more like 60, 65% by number of deals. And that means that hopefully it's going to be well poised to react to the changes that we're seeing, some of which are now no longer changes, but are just changes the way we work, that other businesses perhaps pre-COVID may have been less able to consider. So that is the sort of core of what we do. On differentiated strategy in the top right hand side, let me just tell you just a slight little bit more about what I mean there. So we invest earlier stage, as I said earlier, typically for us early stage is less than £1 million of annualized revenue, and to do that, we deploy smaller amounts of money into early stage businesses, more early stage businesses, in order to get a greater spread and therefore hopefully see a better distribution of return. That means our VCT's aim is to be small, nimble. We do careful capital raises. It's a 10 plus 15 this year. We're not trying to deploy massive sums like 150 million. We're trying to deploy the right amount into really promising early stage opportunities. They need less money and the growth is there. Obviously, the risk of failure is mitigated by both our strategy and also the diversification that we pursue in the portfolio. And by, I say, our strategy, one of the core things we look at with an early stage company is not just their product. Obviously, their team is essential, and we'll talk about that in a second, but is about the way that they're approaching the corporates, the businesses they want to sell to. Do they have real indications of interest? Not a contact they know that is interested in the product, not that they work somewhere and think something's good, but have they got a contract, or at least the growth of prospect that's going to lead to a contract at the point we invest. That's really important because it helps mitigate one of the largest risks associated with early stage investing, which is the lack of product market fit, the fact there's just no one that wants to buy the product. This slide that we've just moved on to is really talking about the early stage investing and the impact that makes. So true value capture in venture capital investing occurs when a company is young. And actually, in that Exits in the UK report that I mentioned, over 70% of exits in the UK happen when a business is valued at under £50 million enterprise value. So it's really important, actually, if you want to take a slug of the equity in businesses that are going to exit successfully, that you enter at a low valuation as possible. And by investing earlier, you get that opportunity. Now, what Billy talked about our co-investment with other VCTs, that does happen. In fact, there was one that happened only at the tail end of last year. And often what we do, because we go slightly earlier, we invest where the little yellow dot is on this slide. And what you see over time is that the valuation in the company, the company grows, and with it, the valuation grows. And then another fund invests at a later stage. They invest more money at a later stage for the next next phase of growth, and they invest at a higher valuation. That's still an attractive deal. But if the business does well, the reality is that we can have a 2 or 3 times bigger return than some of the other VCTs for the same company, and that's because we're investing slightly earlier. And so that's really the opportunity here, and the differentiation that we offer against the rest of the market. And our team are all a mixture of ex-financial, legal, and startup backgrounds, and we're all incredibly enthusiastic about the sort of early stages of entrepreneurship. We've mostly experienced them ourselves, and that's where our specialism lies.
And I suppose this also goes down the route that we've spoken about. And when I say we, me and the wider sales team, when we talk to advisors about, if you're investing in these types of products, be it a VCT, which we're talking about today, or the wider tax efficient products that are out there, EIS and VCT, you are taking risk, you're taking venture risk. So you should be looking for venture return in that side as well. And by capturing that early valuation, that early investment, and being able to ride that further growth that the company sees, you are, as it says there, going to be able to try to potentially have more significant returns by those multipliers, which in essence will provide that NAV growth and that dividend for the clients which they're looking for, which is key. I just want to pick up on one thing that you mentioned earlier on. Obviously, you mentioned market validation for a company's product. You mentioned the team. Obviously, they're 2 of the probably the most significant reasons why companies fail. And one of the things that was spoken about when we looked to launch this VT was mitigating as much risk as possible for those early failures. And there was that research that was done that was looking at the top 10 reasons why business failed. And obviously those 2 there are numbers 1 and 3, and obviously number 2 is running out of cash. This is in essence the sort of forms part of the backbone of what you're talking about, isn't it? We're trying to navigate these issues that startups will face.
Yeah, exactly. I mean, and also number 2 on this list is really a factor of number 1 and 3, right? It's you run out of money because you can't get money because you don't have a need or you don't have the right team. So yeah, really though, you could almost ignore that 29%. Yeah, exactly. So it's the dominant reason. And so if you can look at a great team with experience, we're not trying to fund people who are learning on the job, but people who have been in the area that they're working in, that perhaps have a network or have experienced the problem themselves and know that it's an issue because they themselves were in a large corporate trying to solve it. But yeah, absolutely, that's the key thing that we're looking for, is that market demand. And it's not to say, by the way, that every business that we would invest in always finds a high level of it. I mean, we're early stage investing and there is a level of failure. We build that into our modeling and build that into our expectations. And that's why we have diversification, so that the companies that do well can pull away and really deliver outsized returns. That's venture capital. And just by focusing on this, by emphasizing this point at the point of investment, we're able to ensure that we're putting ourselves in the best position for growth.
And obviously that risk mitigance starts with the investment process. I know predominantly most providers, I do a lot of these sessions with other VC houses or EIS houses, and you see the funnel, and we see 2,000 companies, and we whittle it down, and all of a sudden we have our 8 to 10 companies that we're investing over the year. But for us, it's more of the journey with that company, isn't it? And I think it's that challenge-less approach that we talked about at the very start, which then starts that market validation, and then into the world of all of the complication of due diligence and investment. How different is this compared to the wider VCT marketplace?
Yeah, I'd probably say that, look, when you're a venture capital investing, it's really important you follow most of these steps, and they're probably not hugely differentiated from what you'll see from other credible venture capital investors. But the key emphasis the things we're really looking for here, that if I want to pull out something, is the focus on the founders. I talked about the experience they'd have, but not just that, but alignment. We need the founders to have significant shareholders. They're founder CEOs, founder COOs, founder C-level senior management executives. And we're not looking for the sort of hired in early stage guys who are looking for management who aren't significantly incentivized. So having a material stake in the business as that founder, skin in the game, they say, is really key. Another thing, as I highlighted, was domain expertise. That can come in several forms. It could be that you've previously worked in a business that's solving an adjacent problem, and you've rolled out of that startup to do your thing, or that you've literally been your customer and you've realized it's such a problem that you want to become the person that solves it for the end user. But ultimately, you have knowledge that the venture capitalists that we don't have, that you are materially better than all of us and all of our knowledge in what you're doing. We want experts, outperformers in every position in the companies that we're investing in. And that goes hand in hand with, and indeed is required to get, an innovative product. So the product itself has to be something that's really changing the way things are done. Not to say that it's trite to say it, but Slack and Uber, totally, one in consumer, one in business, totally changed the way things are done. I mean, Microsoft Teams, that many people use if they don't use Slack, was based on Slack. It's like they've changed the way business is done, and that's really what we're focusing on. We're focusing on things that are not just incremental, but are revolutionary in the way things are done. And probably I'd highlight those points over what's on the slide. This slide's a really important slide. It's something that many people do, but often I find that talking about what we're actually looking for in, say, the due diligence stage is so much more meaningful, and that's really what we're focused on.
Fantastic. I realised right at the very start I didn't say this, and I feel ashamed I didn't, but I'll highlight it now. Obviously, me and Seb were happy to talk to you for the whole webinar, but we would want questions, queries, comments as we go through. So please do use the comments box, the Q&A box, whatever you want. We will pick them up as and when we go through the session, and also afterwards if we've got time. So feel free to do it, and don't think that we just want to talk to you for half an hour, 40 minutes and leave it like that. And then let's I suppose sing our own praise for a little bit. Key highlights of the VCT. Obviously some of these numbers have already been up there. We can talk about obviously the dividend, we can talk about the NAV increase, the AUM, but it speaks for itself. 30 investee companies, 12 sectors, good deployment rate, an exit, again, market validation on what we're doing. Anything really sing to you on this slide here?
I would probably just say that the exit's the key thing, right? We've been around for 3 years. Most people don't have exits for 4, 5, 6, 7, sometimes even 10 nowadays years. And the fact we had one relatively soon was obviously a vote of confidence in the strategy. I think what you'll see over time is the investments, the investee companies, of course, the dividends, and the number of sectors going up. And to date, they've gone in the right direction, which is great.
And that NAV growth story, it's, and I think this highlights it, that it's consistent and driven over course of time. It's not just a lump sum increase and we've rode that wave of that 10p increase. It's been consistently increasing over time with the div as well being paid, and that's the valuations of the companies coming in later on down the line with further funding rounds, I'm assuming.
Yeah, no, that's exactly it. So the companies that we're investing in a seed or A, they go on to do follow-on funding rounds. We've had not just one or two, we've had a real number. Some of them have been pretty staggering amounts, to be frank. We've had businesses valued in the significant 9 figures after we invested in just the millions valuation. Some of them now with really top tier names, including Kinnevik, Atomico, Insight Venture Partners, and others, Index. And so that's just really a testament to what we're trying to do and what we're always trying to improve and build on. And that we hope to continue this.
I'll put the next slide up, but I want to maybe throw a question out as well that's come through, which looks a little bit interesting, and obviously it's going to be a bit crystal ball, but we're lucky enough to have our first exit. You talked about obviously the investment journey into the companies and how predominantly it's all happened post-COVID. Over the next 2 years, Seb, would you want to take a stab in the dark at how many exits you think the portfolio might have?
Yeah. Look, at the stage we're at right now, we're actually not targeting any more exits for now. Like, we've been going since 2018. Realistically, we'd want to be holding for at least 5 years. If we get early exits, that's fantastic, and of course a great validation. But we would expect as a team for there not to be significant number of exits for probably 5 years or more. It is an interesting market at the moment, where we are seeing some unexpected interest in our companies for potential exits. But really what we're trying to do is deliver outsized returns, and outsized returns come with time. We have distributable reserves for dividends, etc. but yeah, really, I'd probably say over the next 2 years, we're not looking at a significant number of exits. But you are right that to some extent in venture capital, you are a minority shareholder. Even if you have control rights, which we typically do, you don't control the strategy of the business, and therefore the exit is to a massive extent dictated by the founding team and what their approach is and priorities are.
So this journey, and I say this is one of my favourite slides I think that we have in on the VCT. Obviously, when you stand up and you present alongside some of the other VCT houses, you see a lot more recognisable names because they're that B2C marketplace rather than the B2B. But again, do you want to sort of maybe talk us through some of the journeys? Again, there's been another great question here, which I know we'll talk about probably Quick Genius in one of the next slides, but any of the specific investments you've really enjoyed with doing within the VCT, and what you think the impact that will be, or the impact has been to the actual, NAV, and also any problems that have arisen. I think it's fair. You talked about obviously risk mitigants, and as much as we'd like to make sure we don't have any issues, they are going to arise over time. So I think we should balance it out on both sides.
Yeah. So, this shows you almost all of the portfolio, not quite all, but almost all of the portfolio. So in terms of specific investment, to Rob's question, this is a great time to pick up on what things are doing. So a lot of the NAV growth that we've seen today has come from the top line of this snake, if you call it a snake. And we would expect more of the NAV growth, to come from the second and the third line over the next year and a bit, with that final banner at the bottom, the new investments since August. We don't expect them to move the NAV materially for at least a year and a half, maybe even 2 years. And I think to highlight some, firstly, that perhaps have had problems. So Orgnet at the beginning. So as you can probably see at the top, in the top left, it's the second investment, Orgnet. That business had a really interesting plan that had a spanner thrown into the works with Apple's changes to privacy on iPhone, completely unforeseen in 2019 plan. And it meant that their whole business product strategy had to adapt and change. And that's led to them having much slower growth than we expected. But that's not to be something that surprises us. We expect there to be businesses that have these problems. The company after that, Adepto, was an exit, and we didn't expect that to be so fast. But it was obviously a great outcome for us. And indeed, we now, through that, hold shares in a San Francisco business that have gone up 80% since we received them, which is further compounding the growth in the NAV. But I think the ones I want to highlight probably on the bigger side are 3 of the top line, Ably, Vine, and Quick Genius. All 3 of those have had very material follow-on rounds. Ably and Quick Genius both raising between them approximately $90 million worth of funding, so sort of £70 million. At significant valuations, and we've been there from relatively early on, and it's been a great journey. And those are businesses that we're very proud to back. And then in that second rung, several of them are out raising money at the moment, and some of them have closed it, and that will obviously lead to valuation uplifts potentially in the future. But they're out raising, and so I'm really optimistic. And then if I go to the bottom of this slide, Ride at the very end of the snake, that business, we invested in them in their first year, which was last year, their first year of trading, and they're already very materially up. They're at 7-figure revenues of in only a matter of months, and that's really impressive. So it'd be interesting to see where they go and what they do in the long term.
I know you mentioned Quick Genius, and it blows my mind, Quick Genius, the potential worldwide coverage that company has. When you look at the expansion it's going through and talking about. Again, do you want to sort of just delve a little bit more deeper into it, because it's something I'd never really thought about, with the move to sort of online engagement to help people with issues.
Yeah, so Quick Genius's focus is around helping people to quit addictions. They started with smoking, and smoking's their main one, although they also do deal with drug and alcohol, opioid addiction, sadly, a requirement to have a product in that area, particularly in the US. But effectively, smoking has a material cost to US business, and they are a UK team, but they have pivoted a substantial amount of their business to the US. And the reason they've done that is that in the US, the largest blue chip employers, they don't run private health insurance. They don't have private health insurance. They actually run insurance on their own balance sheet, which means that they themselves effectively operate like an insurance company and absorb the cost of healthcare when it's needed, because it works out overall cheaper for them to do that when they're Walmart and they have hundreds of thousands of employees. And that means that every pound or dollar that can be saved because of addiction is something that they can directly benefit from. And what Genius does is helps their staff. It has over 50% effective rate compared to a larger effective rate than other solutions for solving addiction. And it enables blue chip US employers in particular to save between $3,000 and $4,000 an employee who's a smoker by offering their digital therapeutics tools, which in some cases includes connection with a therapist, but in many cases is self-guided, automated digital. It's effectively a clinical grade phone application that helps you with quitting and behavioral change. And they've obviously grown it very substantially since we invested in them. Octopus is also an investor, and they have raised a Series B with Atomico and Kinnevik. Kinnevik being one of the leading healthcare investors in Europe, and Atomico obviously being one of the largest later stage investors in Europe. And so, yeah, really interesting to see where they go. Valuation is in the 9 figures, material 9 figures now. And yeah, we're really, really excited about what Joseph and the team can achieve.
Lewis has also asked a question, and I suppose it coincides nicely with you just talking there about obviously Octopus being a follow-on investor and a couple of the other VC houses. Don't suppose off the top of your head you'd have an idea of how many of the companies we've invested in are now co-invested with other VCTs?
I think off the top of my head, it's about four or five with other VCTs. With other managers overall, everything is co-invested. But with specifically with a VCT, I think it's 4 or 5. It's very common at the early stage to see co-investment. And very common to see overlap across different funds. But with VCTs, yeah, a handful.
A handful. Perfect. Brilliant. And then just reiterating right at the very start, obviously diversification and differentiator being a key comment that we were talking about. We're not just a diversifier in the fact that obviously we have a B2B focus and we're smaller with regards to the earlier stage investing. We have diversification within the actual VCT itself because of the types of investments that we're making across multiple different sectors.
Yeah.
I mean, this is a fair representation as it stands. Will it change much? Are there areas we're really excited about? Are there areas we'd like to get involved in more?
I think I mean, it's quite difficult to get more diversified than this. We have actually got more diversified from the last pitch that you and I did, Billy, in January to now. There are a couple more sectors on there than there were. It's sort of closing in on 15 almost sectors that we're focusing on. There will always be dominant emphasis on fintech and insurance in particular. You can see it's 25% of the portfolio is fintech and another 11% is insurtech, and that's insurance technology. And that's to be expected when we are a London-based fund investing across the UK, and fintech is by quite a distance the global strength that the UK has in technology. And so we would expect to have that. And also our team has fintech experience, and so really understands what's required to invest in this area. Another area which is growing, creeping up, that we think will continue to creep up is health. We have the largest single payer healthcare system in the world, the NHS. And with a few tweaks to procurement, it could be an incredible breeding ground for talent in the UK. It hasn't fully matured in the way fintech has, but it has a real opportunity. And so, as optimists, we'd probably say it's an area that we think will be a focus. Middleware is dominant in the portfolio because of the Ably investment. Middleware is effectively the back end pipes that that provide the data and information needed for your for the app you see on your phone or on the computer. It's quite technical, but ultimately that's not necessarily a core focus area of ours, although we do know the area well. There are just fewer companies in that area, so we wouldn't necessarily expect that to see an emphasis. But overall, I would see this broad pie with many different colors to be something that remains, and indeed perhaps even grows in number of colors as we continue.
I'm glad you did the middleware explanation. That's quite a comment. So what is middleware, and trying to explain it's it's that center ground between point A and point B with technology. You've done a much better job than I would do.
I don't know. I'm now thinking your explanation is better than mine.
And then obviously, again, we've laboured the early stage investment, the seed, a little bit of pre-seed, some Series A. We want to naturally see the portfolio breakdown move up that ladder, as we see those following investments. And again, that will just reiterate that the investment mandate that you guys are doing there is actually ringing true. And I suppose this again speaks for itself, but it shows that there is that drive towards that Series B, which is those follow-on funding rounds that we've talked about.
Yeah, exactly. So what we aim to do at investment is to have broadly, give or take, broadly 60 to 70, maybe even 80% in some cases of the deals to be that early stage pre £1 million of revenue. Now we do some Series A investments. It's not our core strategy, but by quantum we do some opportunistically. That's what I've just explained there is the left-hand side of this slide. So it's what it looks like at the point we invest. Now, over time, it changes. And on the right-hand side as well, what it looks like after companies are beginning to mature. And naturally, the Series A and B, which is code for effectively more than £1 million of revenue and growing, slowly but surely starts to take up more of the pie, and until you of course exit, get the cash and reinvest at the earlier stage. So that portfolio breakdown we have here is just representative of what we would expect in a maturing portfolio, that things go on from stage to stage, the first 4 stages being pre-seed, seed, A and B, and we would expect to see that continue.
Yeah, and then obviously the end goal is the exits. We're lucky enough to have one, even being still an early or young VCT. I know you've mentioned Adepto, and obviously we now own shares in as a very significant large tech company in the US off the back of that. Do you want to talk us through the exit very quickly?
Yeah, so the business we invested in early 2019, in May 2019, and they exited. They signed the agreement to exit at the beginning of 2020, and we received the shares in 2020 as over the earn-out period. The growth in Degreed itself, it's a fast growth San Francisco based privately owned company that may decide to list in the future, but we also have secondary options if we did decide we wanted liquidity in due course. But it's a really high growth opportunity business, and no other VCT has access to that company. We got offered shares or cash, but given the profile of the acquirer, we opted for shares, which we very much hope will be the right decision, and it does seem to be the right decision at this stage. Really excited for where that will go. It's also great because we have other businesses in our portfolio like Learnably and others in their HR learning and development space, the B2B space, that have a synergy with not just Adepto but with Degreed, and we can obviously help facilitate that, which could lead to sort of stronger growth for the portfolio overall.
Yeah, as I say, just on a side note, we have access to Learnably at Triple Point. I've got to say, I love it as a system, and hopefully it will be accessible to more and more companies going forward. And just want to claw all the way back to right at the very start and the whole business to business focus and mandate. And you mentioned this report. Obviously, we don't need to dwell on this with regards to much time. We're happy to send this out to any advisors that are interested, but this again is just reiterating that message of the more frequent and common exits from the business to business marketplace, and why that is a focus for us. Again,
yeah. I mean, the beauty is the graph on the left hand side, so clear cut. There's not much to say about it, which is that B2B's at the top and B2C's at the bottom, and it just shows exactly what we were talking about earlier about how B2B has such, and it has always had, although it widens with scale over time, that this graph beginning 2011 and coming up to 2019, and the latest report, which only came out this week, which we haven't had time to put into this deck now, covers 2020 and 2021 indeed, and it's only widened more. Valuations themselves are not always substantially different. There is a little bit, generally B2B companies are slightly higher valued, but to be honest with you, it does crisscross. It crisscrosses in the right-hand graph between 2011 and 2012, and indeed in 2021 it crisscrossed again to just be marginally higher for B2C. But the reality is that valuations are useful indicators of potential, but really exits are what crystallizes that valuation and therefore leads to the return. On that, it's probably worth talking about Rob's question. Rob's just asked a question about the VCT. Does it want to genuinely grow capital value? I mean, and saying it's crucial to continue attracting capital into the asset class. I mean, it is a core objective. I mean, I cannot confirm that we will grow capital value. I mean, that's not possible. What I can say is that it is wholeheartedly the aim of the strategy to do that, and we are obviously confident in our ability within, but obviously that's our target, is to do exactly that, to grow both the capital base while offering a dividend. And indeed, our dividend sort of targeting around 3p a year, 3 to 5p a year is designed because we believe capital growth and investing into the businesses will lead to a greater return in the midterm than just giving you back your dividends. Although the first two dividends that we did pay out were paid out of capital because we didn't have cash exit to do that, but we made up for that, more than made up for that in underlying capital growth. So it's certainly our target is to do exactly as you said, Rob.
And is it fair to say, Seb, please feel free to correct me wrong, that the dividends are, ideally that's from realizations of getting those companies?
That is, yeah. All the dividends are technically subject to realizations or the board's discretion.
Yeah. Obviously, you mentioned the wider team. It's ever growing as well. That's the nice thing that we've seen across Triple Point as a whole. But the ventures team obviously has continued to grow and supported by an outside advisory group as well with Christian and Charles.
Yeah. So this is the team. I mean, Jamie's our newest addition. I like to say that we're a team of Avengers. We all have different backgrounds and we've been doing different things. So Ian's from a finance background. I'm both an entrepreneur and an ex-lawyer. Chris is an ex-entrepreneur and actually a best-selling author. Jamie's from a banking background, and Ethan's from a finance background, and Julian's from a banking background. So we have a good array of skills and expertise in the team that complements, and then we're reinforced by what we call our venture network, our advisors. Christian Fays is the co-founder of Lend Invest that recently listed on the London Stock Exchange. We actually, as Triple Point, as a house, invested or lent debt to Christian's business back when it was beginning in 2010-11, and Christian is a very close friend of Triple Point's because of that. And Charles is Charlie, as we call him, is a close friend of ours as well, and he's the founder of Comply Advantage. He's actually also the co-founder of Market Invoice, if you know that business. So he's a real fintech expert. And obviously in the kind of sad events of Ukraine right now is a real expert in all the sanctions, because that's what Comply Advantage does. But having the deep network of Christian and Charlie alongside our team really helps us to assess opportunities and also see opportunities.
Brilliant. And then obviously, most importantly, it's still open. We have the VCT ongoing. Obviously, we've got the current tax year, which is proving fast approaching, and the real driver for today's session. The offer will remain open up until, obviously, it says there, like noon on the 5th of April. So cleared funds, online applications via the Advisor Centre. Obviously, we have editable PDF documents and all that. We'll continue this offer until the 29th of July, where we will, I believe, have a soft close and then look to relaunch potentially at some point in the future. all the current offers regarding existing shareholder discounts and early bird discounts are currently expired, but there still is capacity, although it is, like I say, fast filling up within the VCT and over 55% subscribed at the moment. Most importantly, the charges. Obviously, everyone always wants to know the charges. We have two routes in, via advised retail or professionals. I'll just leave it up there for everyone to digest, but I'll highlight two things because, again, for me, it's all about evolution with the products. And two of the big things that we have changed since the initial launch of this share class within the VCT is the ability to now pay an ongoing advisor charge, but also to have dividend reinvestment. So we are constantly looking to evolve the solution and the product to fit the needs of your clients and what they want and what they need from something like this. And again, to really sort of just try to bring it home to the advisors and power planners that are on the call today, it's about where this can fit within the advice process. Now, for me, and again, looking back to the article I highlighted right at the start, VCTs now I think are becoming, if so more than ever, a real main player within generic financial planning. It's not just reserved for those ultra high net worth individuals. There's loads of opportunities where this can be built in as part of the portfolio of someone's investments. In fact, Harman & Co. recently released a paper on how venture capital can assist in a client's portfolio and especially helping provide them better risk-adjusted return. Now, obviously, it has the benefit of unique access to potential high growth smaller companies. And we've spoken about that early access and the ability to ride the wave of that growth from investing in seed and pre-seed and some early Series A. But it's how that can then be applied to the clients that you're engaged with. Obviously, we've got individuals that will have annual allowance, be that the £40,000 annual allowance or the money purchase annual allowance, and they're looking at an alternative to maybe funding or building their pension and having some form of regular dividend income to supplement that income. You may just look at people who want to maintain and run their pension where it is because of the IHT savings and potentials from there, especially with the pre-75 death benefits that are implied with pension money. And again, building a secondary pot of money which has tax benefits and income availability, tax-free income availability is really important. I'm sure a lot of the clients that you deal with will be higher earners and be in the additional tax rate bands. And again, maybe looking at a way of lowering that tax implications for those individuals, especially if they're in that golden area of around 100 to 130, 140,000, where they start losing their personal allowance and have those additional impacts of maybe loss of benefits. Landlords, we normally talk about landlords and EIS, but obviously those that are actually maintaining their properties and going to be continuing to be landlords for these individuals, they now have the full implications of the interest relief that's applicable to buy-to-let mortgages. So maybe looking at lowering or extracting cash in a more tax efficient way there. It really is far-reaching. It's not purely just because someone is high net worth or ultra high net worth. There's a myriad of opportunities that we can look to utilize VCTs and other tax efficient products in order to help provide a better outcome for someone at the end of the line. But just to reiterate, the VCT is open. It is, in my opinion, a really, really unique opportunity. And I've got to thank Seb for his time and his input today, because I think he's really highlighted some of the key areas where we are different. It is exciting, and we are looking to provide something that is, that is the best of both in the world of VCT on the income and growth side of things. So if you haven't considered the VCT from Triple Point before, I think it's definitely time to do that. We do have the opportunity to continue to take funds right up until the end of tax year. So again, it's for that late planning, which obviously I think a lot of people end up doing. It is available, and it's just part of a suite of the wider offering that Triple Point have. We do have our estate planning service, which backs our lending and leasing arm, the same as our income service. We have the Impact EIS, our digital infrastructure, our social housing, and our energy efficiency fund. And me and the wider sales team will be more than happy to talk to you about any of these if they feel that it will fit your advice process. That just leaves me to put that up there. Say, Seb, thank you very much for your time and your input today. It's been fantastic. Obviously, the passion you speak about the VCT, I think, hopefully comes over to everyone on the call today. And we're really excited about what this is and where it's going. I think we've got one more question. No, it's just
No, thanks very,
we'll
yeah, no,
take that.
thanks very much, guys. Yeah, yeah. No, thanks very much for having me, Billy. Yeah, really appreciate it. Great to talk to everyone. Thanks for joining.
Not a problem. This will be recorded and we will put up on the website for anyone that does want to review it. If you do want to contact from your representative, then they will be in touch over the next day or so. But at that point, I will let everyone have 10 minutes back of their time today at 11:50. Enjoy an early lunch and thank you very much.
Thanks.